every time that you start to see governments complaining about the amount they have to spend on interest, it tells you that they're near to a point of either artificial interest rate repression or rate cuts, and markets themselves can't cope with higher interest rates on a sustained basis because of the widespread use of leverage and the illiquidity. So I don't think the market appreciates that final point very well. The Fed is given a lot of credit, rightly, for how they've reacted, but the Fed's tightening cycle hasn't had contact with the enemy yet. They haven't been tested by a market sell-off, really, or a recession. And it's only then that their reaction function will be revealed. And we're betting that they don't have the stomach because they don't have political support to stay tight.
Imagine spending an hour with the world's greatest traders. Imagine learning from their experiences, their successes, and their failures. Imagine no more. Welcome to Top Traders Unplugged, the place where you can learn from the best hedge fund managers in the world so you can take your manager due diligence or investment career to the next level. Before we begin today's conversation, remember to keep two things in mind. All the discussion we will have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their product before you make investment decisions. Here's your host, veteran hedge fund manager, Niels Kostrup-Larsen.
For me, the best part of my podcasting journey has been the opportunity to speak to a huge range of extraordinary investors from all around the world. In this series, I have invited one of them, namely Alan Dunn, to host a series of in-depth conversations on the topic of what it takes to be a world-class allocator. In today's world, portfolio construction is fast moving to the top of the agenda of many investors as they try to analyze and understand the riskiness of their portfolios. And with ever-increasing uncertainty around the globe, being well diversified across many different strategies and themes in your portfolio can mean the difference between ruin and survival when the next crisis emerge. The aim of these conversations is to try and understand the experiences that have influenced these highly specialized allocators and the processes they follow to harness the best returns for their clients so that we can all become better informed investors. And with that, please welcome Alan Dunn.
Thanks very much for that introduction, Niels. Today, I'm delighted to be joined by Matt Smith, Investment Director at Ruffer. Ruffer is a UK asset manager managing £24 billion in a single absolute return strategy. Matt is a member of the Senior Asset Allocation Committee and one of the senior fund managers at Ruffer. Matt, great to have you with us today. How are you?
I'm good, thanks, Alan. Great to be here, and thanks for having me on the pod.
Not at all. So what we like to do to start off is to get a sense on our guests' background and route to their current role in markets. So maybe if you could give us a bit of your background.
Yeah, sure. So I joined Ruffer straight out of university as a graduate. I studied history at university, not economics like most people in financial markets. I joined onto our institutional team and spent 2015 as an equity analyst in Hong Kong, working for Ruffer out there. And in 2017, I joined our asset allocation committee and started managing portfolios. I'm now a senior fund manager on two of our flagship funds, including our fund for US institutional clients that we launched at the beginning of last year, and a partner in our business.
Good stuff. And maybe for people who don't know much about Ruffer, can you give us a sense on what the philosophy of Ruffer is and the types of portfolios you run, and types of mandates and any kind of restrictions you have in terms of how you allocate capital? Yeah,
so the short answer is that we are an absolute return manager with a single strategy, and we're set up very deliberately to be completely unconstrained. That's arguably the most important thing for any investment manager. We were founded in 1994 by Jonathan Ruffer, who wanted to improve outcomes for clients. He wanted to deliver absolute returns at a time when the industry only really offered relative returns. We're quite unusual in that our primary investment objective is to avoid losing money. Now, we're not unique, but that sounds pretty unambitious. But it's a lens that has allowed us to deliver positive returns through all four of the major market crashes or bear markets since our inception. So it's positive returns in the dot-com bust, in the great financial crisis, in March 2020, the COVID crash, and also in the correlated bond equity bear market of last year. And how we do that is we primarily focus on the risk of losing money. Most participants in the industry, most investors focus on return maximization. They construct a portfolio of return-seeking assets. I hope it kind of roughly blends into a solid portfolio. And then they might do risk management as a kind of afterthought. We start from the perspective of risk minimization. What are the risks to client capital that are out there? Are they risks that we need to protect against? Are there asymmetric investments that we can use to protect against them? And if the answer to those questions is yes, we'll put in place protection against those risks essentially right away. That would, if we just did that, we'd be a kind of British tail hedge fund. But we think that the key with investing is to avoid timing the passing of the events that you're worried about. So on top of that kind of core of protective assets, and those can be protecting against regime change, market change, a number of different things. We will overlay onto that core what we call growth assets, but essentially assets that will work if the protective assets aren't required. And by balancing those assets to create a kind of all-weather portfolio, you can try and strip out timing from the equation. I think that's gives us a huge edge. Most people believe that they can predict what's going to happen in financial markets or in the economy, but they can't resist going on to predict when it's going to happen. That's predicting the future, which is, as we know, impossible by definition. We think if you strip out the timing, you stand a much better chance of being right. And that's how we've been able to deliver returns that are roughly in line with equity markets over our 28-year history, but with a volatility much more like a bond.
Very good. Well, maybe to get into some current topics in markets, this is probably a good segue in terms of predictions and people getting it wrong. The feature of this year that's probably been interesting has been the resilience of the US economy in particular. I guess if we went back to the end of last year, forecast of recession was fairly widespread, and if we went back even further, people would never have, the majority in markets wouldn't have anticipated rates getting up to 5.5%, I think it's fair to say, in the US. What do you think the consensus has been wrong, and what's your read on the economy at this point in terms of the resilience in the face of a tightening cycle?
I think there are a number of important dynamics, but probably the most important one is the degree to which financial markets are programmed to deal with rates of change rather than levels, or programmed to focus on them. What does that mean? The level of inflation is much less important than its trajectory or its speed. The level of interest rates is much less important than the level of rates volatility. So if we wind back to the period of peak pain for markets, sort of September last year, we're clearly at a much higher risk-free rate now than we were then, much higher level of real yields, slightly higher. We have now passed the October peaks in nominal yields. But what's happened is that there's been a significant slowing in the rate of change. So rates volatility, as we effectively, as inflation topped out and it became clear that the Fed was getting nearer to its terminal rate, nearer to the end of the hiking cycle, rates volatility came down a long way. The fears at the time over an energy crisis and a recession in Europe and a China that was seemingly stuck in lockdown, those have all unwound, contributing effectively to an elimination of left tail events in the market's perception. That does matter a lot. Everyone was extremely bearishly positioned at the beginning of the year, and risk appetite was very low. Goldman Sachs have done some excellent work showing that for a 60-40 portfolio, that sentiment and positioning is the single best predictor ex ante of returns for a 60-40 portfolio. So for me, we need to remember that we're in a hyper-financialized era. What financial markets see is absolutely critical to how they perform. So the fact that these tail events have been eliminated, that volatility has come down a long way, has contributed to a significant re-leveraging in markets that has muted the impact of the Fed's tightening. So the compression in credit spreads does lower borrowing costs for corporates, despite the fact that the Fed is hiking. The rise in equity markets does send a positive signal to CEOs whose share prices are rising, to consumers whose portfolios are getting bigger. This has a kind of a momentum of its own. And so the market has been able to defy this huge rise in the risk-free rate because of a re-leveraging dynamic that, I think importantly, this tells you something about our outlook, is largely exhausted. And quite soon what you'll be left with is the sort of the naked reality of a 5.5% risk-free rate and north of 2% real yield.
Interesting. And I mean, you touched on kind of constructing portfolios without relying on having to call the timing of these events. So I'm just curious. So, I mean, practically then from a kind of a portfolio positioning perspective, given what you're saying, is it, give us a sense on how you kind of deal with that market backdrop of something you feel will eventually run out of steam, but you're not quite sure whether it's this month or next month or in 6 months' time. Is that where your kind of protective strategies come into play?
Absolutely. So if we leave aside our structural views on inflation, which we can come back to, and look at what is this cyclical dynamic that we're describing, I think if you had to put it in a sentence, I would say that there are almost no risk premia in the market that are commensurate with both the level of risk-free rates, i.e. the competition from non-risk, and the breadth of potential outcomes in economic and inflation terms from here. So the portfolio construction that should follow off the back of that is one that is heavily allocated to the risk-free rate. It's important to remember that the risk-free rate is rising very, very sharply in real terms, i.e. adjusted for inflation from a trough of -8% in May last year to north of 2% now. And it would also be expected in your portfolio that you would be broadly short of risk premia. And that gets you to a core of our portfolio construction at the moment. Quite high levels of short-dated bonds, around 2/5 of the portfolio, and a number of derivatives that, in their impact, are long of volatility or effectively long of spreads, i.e. expecting risk premia to widen. So that's equity markets to fall, credit spreads to rise, that sort of thing. Now, if I finish there, as I say, that would be a portfolio that was kind of timing things pretty aggressively. So we have to ask ourselves, what are the dynamics that could cause risk to continue to enjoy life? And we think that continued strong economic growth or strong economic outturns is the most likely scenario for us to be wrong about being bearishly positioned. And so the least financial market sensitive but economically sensitive assets that we can find are what we've paired on the other side of the portfolio. And that's things like crude oil exposure, copper exposure, and commodity-related currencies like the Australian dollar alongside energy equities. Now, we are lucky, I guess, at the moment in that the risk-free rate is so high that you can pay for quite a lot of what is effectively tail protection just from the carry at the moment. And we are taking advantage of that. I think and we can come back to the structural assets, but the asset that I haven't mentioned is a significant position in the Japanese yen, which is a helpfully kind of two-headed investment. In the short term, it's behaving just as duration, and so it's selling off pretty sharply alongside bonds. But and so if there's a recession or bonds start to work, you should expect good returns from the yen. But it also has effectively an event risk in its favor, which is that the Bank of Japan are forced to lift the cap or forced to stop intervening in the 10-year market, or indeed that they start raising deposit rates off of the, from below the zero lower bound. That we think is the kind of two-headed investment that will carry the portfolio in multiple environments.
Very good. So obviously, it sounds obviously you're very defensively positioned, and I mean, you touched on the risk to the portfolio is the I suppose ongoing economic growth, and I mean it's interesting. You talk about kind of the comparison of this year versus say the peak of the pain last year around September, early October, and maybe if you were to characterize last year, was very much these concerns around stagflation, which were very much to the fore, and certainly heading into the winter in Europe as well. Whereas this year, economic performance has held up. So anybody betting on a soft landing or even a Goldilocks scenario has been rewarded. And we've had the additional fillip of this boom around AI as well as being a potential productivity enhancer as well. So it's kind of flipped from stagflation to Goldilocks in the space of kind of 12 months. It sounds like you're skeptical of that Goldilocks AI boom being sustained, but tell us why.
You'd be correct. The AI narrative is a particularly interesting one because it does two things with respect to real yields. Firstly, in theory, it allows for a higher clearing level of real yields in the economy. AI is a productivity enhancing technology. Therefore, the economy can cope with higher real yields. It's a more productive economy. I'll come back to why we don't think that's correct. But secondly, it has allowed the NASDAQ, or more specifically NASDAQ valuation multiples, to disconnect from the prevailing level of real yields in a way that they haven't done for over a decade. As real yields have continued to rise this year, the NASDAQ has continued to get more expensive. And the reason that AI allows that is that, what's the kind of variable, what's X in the background there that allows for this to happen? It's a sharp rise in earnings expectations. And that AI allows you to explain that. As I said before, I think it's actually been a significant releveraging or allocation to risk in financial markets that has permitted this defying of gravity. If we wind back to the collapse of Silicon Valley Bank in March, that was an event that saw a sharp rise in implied correlation in US equity markets, despite the fact that it was very disparate in its impact. So what happened in the months following SVB, financials performed very, very poorly. It was a banking crisis after all, and tech and staples, companies that are perceived as recession-proof, outperformed significantly, i.e. a significant rise in equity market dispersion. The people trading equity market dispersion, the way they implement that trade results in a sale of volatility at the equity market level. And you can see that pretty clearly in the trajectory of the VIX following SVB. And, who are the investors who are forced to react when the VIX falls? Vol control, vol targeting funds, the people for whom volatility is an input. They started allocating to risk through April. And once vol control people have been allocating for long enough, guess who has to come along afterwards? It's momentum players, the systematic strategies that effectively algorithmically allocate to performing markets. So put all of this together, you've got a significant rise in systematic positioning. CTAs, vol control, risk parity are all adding risk through April and May. And what you're presented with in June as a discretionary fund manager is a market that you are very far behind. Or if you're a hedge fund, a market that you've probably been short of and are feeling the pain of that. And June saw really a sort of discretionary stop in as a result, but continued through July. A fall in mutual fund cash balances, a fall in hedge fund shorts. We think that is what has allowed this significant dispersion between risk-free rates and real yields and equity markets. So, long way of answering your question, to say that AI is a narrative attached to price. We think, there are clearly, it does not say that AI isn't a thing. It's clearly, like the internet, it's an adaptive general purpose technology that is almost certain to have very profound impacts on the economy. But it is not possible, I don't think, to say it is why the stock market has performed the way it has in this kind of 6-month period.
You touched on, you referenced kind of the more structural view kind of behind your thinking, and obviously the cyclical view being that this run up has been more driven by market dynamics as opposed to fundamentals, I guess, to summarize. Equally, there remains out there a split of opinion, as there always is in markets, around the kind of inflation, disinflation, maybe debate. Obviously, maybe going back a year ago, the thoughts of kind of inflation becoming embedded in the system were much more widespread. And, people who have been looking for the immaculate disinflation will probably feel that they've got it so far. Where do you see that playing out? And it sounds like structurally you have a view that of possibly higher inflation over time. Is that fair to say?
That is fair to say. I think if I had to put it simply, long-dated inflation risk premia are the only attractive risk premia in markets today. We are going to be shifting to a different regime. Now, it's a regime, I think, importantly, of inflation volatility. We're not returning to the 1970s, not returning to an era of double-digit inflation, I don't think, but we are living in an increasingly inflation-biased economic system with a financial market that cannot cope with higher interest rates and a political system that cannot impose them. So the correct shift, and this is stolen from Dario Perkins, the very fine macroeconomist at TS Lombard, an inflation ceiling of 2%, which was the dynamic of the 2010s, becomes an inflation floor of 2%. What else does that mean? We shift from a regime characterized by an absence of inflation risk, and we can talk through the implications of that, to a regime characterized by an ever-present inflation risk. So inflation might be low, and indeed I think you can kind of feel this at the moment. Inflation is low, and certainly coming down. There's no real certainty over its future path. There's a lot of hope, but certainly it is not like the pre-COVID era where it was either 2% or it was lower. Why are we of this view? There are 3 key dynamics. The first is that the disinflationary forces of the pre-COVID era, which economists call the disparate confounding dynamics, which is a classic economist way of making something quite simple seem very complex. They are waning to zero, and in some cases reversing. Primarily, that's China. China, from the early 1990s through to the late 2010s was a country that had a repressed exchange rate regime. They devalued the RMB by 40% in 1994 and broadly followed a weak currency policy thereafter. They took the proceeds of repressing their currency and put them into US treasuries, repressing US interest rates, and they repressed the deposit rate in China for the banking system in order to allow for a huge movement of capital from depositors into investment, and to allow them to effectively continually add to supply capacity and to mop up bad debts. We've called this the deflation machine. That led to a huge fall in developed market yields, a great wave of cheap goods onto global markets. Where we are today with China is essentially the reverse. They are drawing down their treasuries in order to support the currency. The average Chinese wage has risen tenfold since the early 90s, and their banking system has had the deposit rate liberalized and is struggling to deal with bad debts. I think we can. There's not much you can say with certainty about China, but that their property sector is in difficulty is something I think we can get away with. On top of that, the energy dynamics of the last 30 years, which broadly were characterized by a wave of cheap energy and cheap commodities, primarily out of the dissolving Soviet Union, kind of landing onto global markets, global economies. I think that's empirically in reverse. We've blocked the export of those commodities and energy from Russia, and net zero, which has many merits. We shouldn't forget that it is essentially a duplication of capacity. The system currently exists to furnish the world economy with its energy needs. Decarbonization involves duplicating that system, and even if it doesn't cost more, sort of separate debate, you are adding a lot of redundancy to a system that doesn't currently need it. So I'm kind of lumping all of those under end to disinflationary forces. The second key factor is that there is a distributional battle going on in the economy. This is something that is visible throughout human history. It's why I think history is such an important lens for investment. Whenever there is a battle between labor and capital and governments, inflation is the result, and it will continue until that battle is resolved. The quote from Ben Hunt, who has been on your pod before, is that shortages are the first sign of inflation in the wild. And I think that's it's so important, that concept. If something is underpriced, it will be in shortage. It won't be in shortage if its price rises. Why did we all run out of loo paper at the beginning of COVID? It's not because there wasn't enough, it's because it was underpriced. So shortages of labor, otherwise known as very low unemployment, or most importantly strikes, I think are a perfect example of the degree to which wages are set to rise. Workers are asking for pay rises, getting them, and then going on strike. They're going on strike and they're getting pay rises as a result. Wage rises are always at the core of any durable inflationary episode. Capitalism and democracy are always in tension. Democracy is a one man, one vote system, and capitalism is a $1, one vote system. At the moment, having gone through a long era of capitalism being more powerful, I think we're seeing what happens if that gets to an extreme and democracy is starting to fight back, or the one person power is increasing. So, final factor, the inability of governments and central banks to tighten properly. Governments can't afford higher interest rates because of the burden that it imposes on their budgets. We're already starting to see that. in the media. That's an absolutely classic historical signpost. Every time that you start to see governments complaining about the amount they have to spend on interest, it tells you that they're near to a point of either artificial interest rate repression or rate cuts, and markets themselves can't cope with higher interest rates on a sustained basis because of the widespread use of leverage and illiquidity. So I don't think the market appreciates that final point very well. The Fed is given a lot of credit, rightly, for how they've reacted, but the Fed's tightening cycle hasn't had contact with the enemy yet. They haven't been tested by a market sell-off, really, or a recession. And it's only then that their reaction function will be revealed. And we're betting that they don't have the stomach because they don't have political support to stay tight.
Interesting. There's a lot to delve into there. My own personal bias is probably to agree with much of what you said, but from doing this podcast and the global macro, you get to hear lots of different viewpoints. So I could push back on some of those points with some comments that I've had from guests. So so maybe I'll throw a few at you, get your perspective. One, look at I hear you. The China perspective, the disinflation to inflation, is probably the kind of the Charles Goodhart kind of argument around the labor force. But equally, we've literally just seen deflation in China in the last number of months, and there's also concern, as you point out, around the property sector and potential Japanification of China, in the sense of high levels of debt there leading to a kind of a structural headwind to growth, and I guess slower growth on an ongoing basis, which sounds not a very inflationary scenario. And equally, China seems to continue to flood the global markets with cheap goods, in the sense that the EU now investigating the infiltration of EVs from China into European markets, and why that's happening. So maybe that just on China, on the kind of the capital versus labor point. Again, we're in a month where we're seeing the UAW striking. It seems like a fair point to make. But equally, if we'd gone back maybe a year or 2 years, people would have said, the cost of doing business has gone down, cost of labor is lower. We've got Zoom, people don't have to be physically present. You've got an economy characterized by a lot of high-tech software development, that actually there's going to be a surplus of capital, because this is the explanation for the long-term trend decline of bond yields. That capital can't be absorbed in a kind of an economy where investment is kind of very capital efficient, and there's not that demand for the capital. And then maybe the final one, I guess around the energy and net zero, pushback on that is will it actually happen? Obviously we've got a green agenda at the moment, and probably in the US a president who is sympathetic to that, but we've got an election next year. If you had Trump or something equivalent coming back, could that all be put on hold? So maybe just get your thoughts on the risks to your own scenario in terms of that kind of structural inflation view.
Absolutely, and there are plenty of risks, but we shouldn't forget the most brilliant thing about financial markets is that everything has a probability or an odds applied to it in the form of a price. For me, that's why investing is so interesting. You can be right, but still lose money, and you can be wrong, but still make money if the price that you're paying is right. Put another way, a good idea can be turned into a bad investment by price. And why is that relevant here? Because long-dated inflation break-evens are still at 2%. If you think of those as the market's assessment of central bank credibility, that is the market saying, I believe the Federal Reserve has the tools and the endurance to tighten sufficiently to return us to 2%, and that we'll stay there. And, to me, that's like a SpaceX rocket landing. The SpaceX rocket takes off, it goes kind of 100,000 feet into the air, well into space, and comes back and lands on a ship in the middle of the sea. It's an incredible feat, but you don't want to see the blooper reel of when they misjudged it. So to take those points in turn, China is in a deflationary moment at this time, and Japanification is certainly something that people are talking about. The mindset of the Chinese leadership is that they are terrified of inflation. It was an important factor in the civil unrest in the early 90s and late 80s. So they are very cautious about anything that could lead to inflation becoming unanchored within China. So what does that mean? It means that they are very cautious with stimulus at the moment. They can see the degree to which inflation is prevalent in the rest of the world, albeit coming down. They don't want to add more debt into the system. They can see that they have huge levels of debt at the corporate level. And so all the stimulus measures so far are pretty tentative. However, they are not stupid, and like the West, they recognize that a highly leveraged economy like their own is like a shark. A shark can't stop swimming because then oxygen doesn't pass over its gills and it dies. A highly leveraged economy, one with a lot of debt, must continue to have nominal expansion. Otherwise, it suffers a debt deflation and a kind of a vicious spiral down. So they're trying to strike a balance between the two. To our mind, they are like the West in that they will prefer high, but not out of control inflation to any threat of deflation. So we're at a moment in time where it looks deflationary, but don't forget that low levels of inflation domestically gives them the monetary space to absorb bad debts. That's their historical playbook. And, it's probable to our mind that they will stimulate eventually enough to restart the economy. That could involve a currency devaluation, which is a disinflationary force for the rest of the world, but we haven't seen that yet. And with regard to labor and the productivity boom that is undoubtedly ongoing, I think this is a classic example of where capitalism, which is a system designed to produce goods and services more cheaply, and comes into conflict with democracy, which is a system where people vote for what they want. If you look at capitalism in the 19th century, on the whole, it made people richer by reducing the price of the goods that they were buying. That's what technology does. It's a deflationary force. It's therefore arguably inconsistent with an inflation target, which is one way that central banks attempt to resolve this difficulty with democracy. However, when capitalism gets to an extreme, and I think that's where we are today or have been recently, democracy starts to fight back, and that's usually in the form of populism. That is exactly what we've seen, both in terms of vote share, people moving towards the right, but also in terms of policies. The policies that governments are introducing are not ones that favor efficient capital allocation. They're ones that favor nationalism or policies, industrial policy that they may want to impose. And I think most importantly, governments operating in the prior regime still. If you think about the credit crisis or the COVID crisis, those were unequivocally deflationary events. Credit contraction, inflation falls to negative levels in the case of the financial crisis, and that correctly had significant inflationary stimulus applied to it in the form of fiscal stimulus, monetary stimulus. The energy crisis of 2022 was an inflationary crisis, and yet it had the same policy prescription applied to it. In Europe, people received subsidies. In the UK, you had money literally taken off your energy bill. In California, the state government gave subsidies to try and mitigate the effects of the high gasoline price. It's very, very simple economics. If you attempt to fight inflation by giving money to the people who are trying to buy something that's at a high price, you will not succeed in solving that inflation. So it's just the degree to which labor is starting to fight back against capital outweighs the productivity increases that technology is and always has brought to the table.
Good stuff. Maybe just to shift gears a little bit, you mentioned at the outset studying history in university, and I guess also for somebody who's come into the markets, in 2011, you mentioned sometimes commentators make comments about fund managers who weren't around for the financial crisis and have only seen low yields. So I guess one way to address that is having studied history. I presume that's the case, but get your comment on that. More generally, taking that historical lens, whenever we talk about history, there's always that desire to draw parallels with the past and what does the current setup look most similar to? Do you think that's a useful perspective? And if so, where are the parallels? Where are the differences now?
Yeah, I think it's a very useful perspective. I would argue it's the most useful perspective. One has to be very careful with historical parallels because the temptation is always to draw them too closely to say that this is exactly like XYZ historical time period. Really, the correct observation, I think, is that what history shows you is that humans presented with similar events or similar incentives or similar setups will react in similar ways to how they have done in the past. What I've learned from Jonathan Ruffer, our founder, is that older perspectives on money and markets, i.e. time-honored ones, are often the ones much more worth paying attention to because of the lucidity and the simplicity that they offer. And, it is always startling to me whenever I read a historical book, how there is simply nothing new under the sun. The degree to which everything that we experience in financial markets, everything that we think is new, ZERP, yield curve control, these are all things that have been tried before, and they always end the same way. There's a quote from John Locke, writing in 1691, "If ill husbandry has wasted our riches, we cannot hope, simply by reducing the rate of interest, to raise them to their former value." Put another way, if you've been wasting capital, misallocating it, cutting rates to zero, just simply won't restore the wealth that you had. It might restore it in monetary terms, but it will be less fully collateralized. So what do I think is the parallel for today, albeit with the caveat that you can't over extrapolate these things? I think the 1940s and 50s provides a very interesting lens through which to look at today. The 1920s saw a significant credit and stock market boom in the United States, driven by interest rates that were set too low for the economic setup of the time. The reason for that is broadly that the UK had gone back onto the gold standard at too high a price, and the Bank of England governor was leaning on the Fed to keep rates low to stop gold sort of pouring out of the country. So the Fed was too low, inappropriately low, spawned this huge stock market boom that eventually led to a banking crisis. And after the banking crisis, you had a period of malaise where it didn't really resolve very quickly. Broadly, you were in a kind of low growth environment for a number of years until you had a very significant kind of world shock and very large fiscal stimulus in the form of the Second World War. I think there are relevant parallels there to the kind of the 2000s, stock market boom from rates being set too low, banking crisis, period of stagnation, world-changing event. That world-changing event in both cases disrupted the supply side of the economy very significantly. It left people unable to spend money that they had. You weren't allowed to travel in COVID, but it's not like you could go to France in 1942 either. And so when these events ended, you were left with a lot of surplus capital in people's hands, supply side disruption, factories bombed rather than factories shut. And you saw in the 1940s and 50s a very significant episodic inflation. It went from 0 to 10, and back to 0, sometimes negative, back to 12, back to 0. It was very volatile. Things kind of continued in that vein, albeit smoothing for a time. I think that's the period we've been through, one of high realized inflation, but not unanchored inflation expectations. I think what's going on at the moment is more akin to the 1960s, where the inflationary pressures are building. You can see that, tightening attempts are happening around the world. We think that they will be unwound once the pain of tightening becomes apparent. And really, that is what embeds inflation, is taking the handbrake off at 3.5% rather than 2%. It's a process of higher highs and higher lows in inflation. That's what long-dated break-evens don't recognize, and I think that's the investment opportunity.
Okay, interesting. Now, obviously, you kind of talked about the post-war. A lot of people draw a parallel between what we've experienced with COVID. Obviously, it's not the same as World War II, but it was fighting a war of sorts, and the policy reaction was similar in terms of big jump up in debt. One of the differences, I guess, post World War II is that we had, I think, strong economic growth in that decade. It helped bring back the GDP levels, which might be more difficult now. You kind of touched on then the 60s as kind of obviously the 60s was that period of great success for a while in terms of macroeconomics and active fiscal policy and kind of the belief in the Phillips curve and the ability to be able to exploit it. So there is that sense that we were something like that going back a few years in terms of policymakers' belief that they could push up inflation to exactly 2.0%. So definitely take your point there. I mean, one difference between all of this is maybe coming into, maybe not so much now, but certainly going back a year, valuations in financial markets are still relatively high in terms of the equity side. Which is probably an outlier relative to those periods you talked about. I'd say P multiples must have been very low after World War II. So, I mean, when you're taking that historical lens and some factors line up, but then there's something quite distinct. Whereas if you're to take it maybe a financial markets perspective, you might have said, at the end of 2021, things looked like 1999 from the technology boom perspective. How do you kind of balance, financial market trends versus macro trends and all of these things when you're trying to look for insight from history, I guess?
Yeah, well, what's useful is to look at what the differences are to today. As you say, the 40s, 50s, 60s, very strong, especially nominal GDP growth helped reduce the debt to GDP ratio very, very quickly. What did they have then, which we do not have today? Credit controls. An environment of high inflation and effectively negative real rates is a very effective way of reducing debt burdens unless people are able to issue credit. If there's a prevailing negative real rate in the economy, people will borrow. They are incentivized to do so. And the immediate post-war era, one of very tight capital currency credit controls, was one where you could have high inflation and high growth and deal with debt because no one was allowed to issue more debt. As we know, if you had to characterize 2021 in a sentence, I think a significant amount of issuance, equity and debt would be pretty accurate. So, one of the things we do here is to try and think in different time horizons to the market. I think looking over the horizon, that's something that we have to be aware of. How do governments try and engineer financial repression to deal with their own debt burdens without also incentivizing the rest of the economy to borrow? Valuations is a key lens, obviously. The equity risk premium hit somewhere between 1,200 and 1,500 basis points in the 50s, very, very high. Arguably, bond market was repressed in that era. which will artificially increase the equity risk premium, just like Japan today. But the US real equity risk premium today is 1.5%. Historically, the 10-year excess real return that you should expect from equities, if the real equity risk premium is at 1.5%, is 1.5%. Now, that's a pretty poor risk reward. That's wrong if earnings increase significantly, but margins are at extremely high levels. Everything is priced pretty well. Most companies are very well run. The balance sheets are optimized. The supply chains are lean. So that doesn't look like a asymmetric place to have capital allocated to us, especially given the competition from risk-free real rates, which is obviously incorporated into the real ERP, but the where you sit in risk terms is very, very different.
You touched on financial repression, and it's been certainly an important topic and theme, I would say, ever since we had this jump up in debt levels since COVID. And I mean, there has been a general sense that this might be how we ultimately bring debt levels down over time. Barry Eichengreen had a paper that he presented at Jackson Hole, and he was kind of basically saying that high debt levels are here to stay because I think his view was financial repression was easier maybe to implement structurally back in the 60s, 70s for various reasons. I mean, you had maybe control over interest rates and, as you say, deposit rates as well. I mean, what's your thoughts on that as to practically how financial repression may be implemented this time round? And would you see that as being the likely scenario over the next kind of 10, 15 years?
Yes, is the short answer. I do think it is likely because I think the true meaning of deglobalization is not deglobalization of supply chains. That may happen. It's deglobalization of capital flows. And that is one of the ways in which capital can be kind of kettled and made to serve the purpose of governments.
And sorry, is that, you mean capital controls effectively?
Well, if the US government says you may not invest in China, is that a capital control? It's not seen as you can't take your money out of the country, but by eliminating a destination, it has a similar impact. And that, I think, gets you to the most likely way in which governments begin financial repression. They recognize that the most explicit form of financial repression, yield curve control, or forward guidance or QE, does have dangerous impacts on the currency if you're in a high inflation era. So it's macro-pru, I think, is the most likely tool. So we have been living in an era of financial repression for a very long time, real yields being negative. And one of the ways that governments achieve forced buying of government bonds is through regulation. Even now, people are very skeptical of the idea that the government could force savings institutions to buy government bonds. That is seen as a kind of something from a bygone era. But that is exactly what Basel III, Solvency II, all of the regulatory frameworks that have come in, with the objective of stabilizing institutions, or certainly that's the labeled objective, but the impact is just to force a greater and greater reallocation from all assets into government bonds. So, the path is well trodden, and I think that is a tool that they will not be afraid to use. There are kind of attempts to go the other way. In the UK, they are saying, you should be reallocating from bonds to growth equity, which seems a sort of fabulous example of government's ability to time markets. But, this is, I think that is something that they will absolutely continue to use. We will probably see it first or next in Japan as they try and release themselves from the straitjacket of yield curve control. Whether it's a soft tap on the shoulder of the guy running Mitsubishi Bank to start putting some of his capital into the JGB market, or whether it's explicit regulation, the impact is the same.
Very good. I'm just conscious that we're running up on time. And before we let guests go, it's always good to get kind of some different perspectives on and advice. And obviously, for people kind of starting off in the industry, or maybe people more generally who are interested in learning more about how history applies to financial markets, which seems to be a particular favorite of yours. Any particular advice around that, or any books that you feel were particularly influential in your own journey in markets?
Books are essential. Probably the most important ingredient for a successful career in financial markets is intellectual curiosity, because what that tends to bring with it is intellectual flexibility, because you read so many different perspectives. And ultimately, with macro investing, if you are inflexible, the market will just push you to the wall. The books that I think have been most important for me in contextualizing what's going on today are The Price of Time by Edward Chancellor, who I know has been on the pod before. It is just the most fabulous encapsulation of the degree to which we've seen it all before. Policymakers have tried what they're trying now for honestly thousands of years. And what's so brilliant is that he cites, I think, a tablet from Hammurabi's code that sets, the maximum interest rates on borrowings, i.e. the first example of financial regulation, and immediately the first form of regulatory arbitrage forms underneath it. So human history is just this continuous cycle of governments trying to push things one way, humans working out how to make it go the other way, and the volatility that results. So that's pretty essential. Lords of Finance is, it's a pretty commonly recommended book, but it does give you the best account of the monetary dynamics from the end of the gold standard to the post-Bretton Woods era. And I think that's vital to understanding how monetary policy, international capital flows are likely to play out in the future, and long-term investment, especially from a capital preservation perspective. If you want to deliver generational wealth preservation, to carry your wealth through time, to carry your clients' wealth through time, you need to be able to imagine things that seem unimaginable today because they've all been tried. And I think we're going to go back to the unimaginable. And Lords of Finance has got plenty of examples of what that looks like.
Great stuff. Well, there are two great suggestions. So thanks very much, Matt, for coming on today. This has been a terrific conversation. So make sure to follow Matt's work because it's important, obviously, in today's world. It's an ever-changing financial landscape. So to consider all these aspects when we're allocating capital. So from all of us here at Top Traders Unplugged, thanks very much for tuning in, and we'll be back soon with more exciting episodes. So stay tuned.
Thanks for listening to Top Traders Unplugged. If you feel you learned something of value from today's episode, the best way to stay updated is to go on over to iTunes and subscribe to the show so that you'll be sure to get all the new episodes as they're released. We have some amazing guests lined up for you, and to ensure our show continues to grow, please leave us an honest rating and review in iTunes. It only takes a minute, and it's the best way to show us you love the podcast. We'll see you next time on Top Traders Unplugged.